Welcome back to the deep dive. This time we're going through some real estate investing stories and market trends and investor psychology, and even a glimpse into the future of Social Security.
Yeah, it's so interesting to see how all these things can connect together. What starts as a personal financial decision can play out on a much larger scale.
For sure. And with this mix of sources, you've given us a lot to unpack. So let's just dive right in with a real estate success story. We found Kim Yu, this investor who went from like a rough first flip to building a pretty substantial real estate portfolio in just a few years.
Yeah, his adaptability really stands out. He didn't just stick to one strategy. He did flips, rentals, creative financing, and explored different markets too. Kentucky, Iowa, just diversifying his portfolio.
And he even tried some unique tactics like sending handwritten letters to homeowners in foreclosure.
It paid off too that persistence helped him find some unbelievable deals.
It reminds me that real estate isn't just about property. It's about the people, too. Networking and building those connections. Even through something as simple as a handwritten letter, it can open up so many opportunities.
Oh, absolutely.
Speaking of opportunities, there's this crazy anecdote about Tim where he actually got paid $200 to buy a house. He managed this through a VA loan and something called seller concessions, where the seller helps cover some of those closing costs.
That's a perfect example of how knowing the ins and outs of financing can create win-win situations. Seller concessions are a great tool, especially in a competitive market, but it takes research and negotiation to really make them work for you.
Tim's story is definitely inspiring,
Yeah.
but a lot of us aren't veterans and may not have a ton of cash on hand. So are there any low or no money down strategies that still work in 2025? It seems like one of the sources thinks so.
Definitely. Even in a changing market, there are ways to get started with limited capital. The source highlights 4 key strategies: partnerships, creative financing, house hacking, and the BRRRR method.
Okay, let's start with partnerships. Finding someone to invest with sounds simple enough. But how do you structure these partnerships so everyone benefits?
Well, the great thing about partnerships is they're flexible. You can really tailor them to your needs and strengths. For example, you might be the one managing the property while your partner provides the capital.
One of the sources actually talked about how their experience as a managing partner helped them offset a loan they took from another partner for their share of the down payment.
Exactly. It's about leveraging each other's strengths and finding a structure that makes sense financially for everyone. Partnerships aren't just for beginners either. Even seasoned investors use them to grow their portfolios and manage risk.
Now, what about creative financing? It sounds a bit mysterious, but is it really that complicated?
Not at all. It just means looking beyond traditional mortgages. Think seller financing, where the seller becomes the lender, or assumable mortgages, where you take over an existing mortgage on a property.
These strategies seem especially useful now with the high interest rates we're seeing in 2025.
Exactly. They can offer lower interest rates and more flexible terms than conventional loans. However, it's important to thoroughly research these options and understand the legal side of things before jumping in. Talking to a real estate attorney is always a smart move.
Good advice. Now let's talk about house hacking. It's a strategy often recommended for new investors. What are the pros and cons in today's market?
Well, house hacking is essentially living in one unit of a multifamily property and renting out the others. It's a great way to lower your living expenses and make investing more affordable. You're basically using your tenant's rent to cover your mortgage.
Sounds ideal for someone starting out.
It can be.
Right.
However, it's not feasible in every market, and you really need the numbers to work in your favor. With rising interest rates, it's crucial to carefully analyze potential rental income and expenses to make sure it's a viable strategy.
You've got to do your homework before jumping in. Right? Lastly, we have the BRRRR method: buy, rehab, rent, refinance, repeat. It sounds almost too good to be true. Is it still a viable strategy today?
The BRRR method can still work, but it's important to be realistic. One source actually debunks the myth of the perfect BRRR, where you recoup your entire initial investment through refinancing. In today's market, with higher interest rates, you'll likely need to leave some equity in the deal and scale more gradually.
So be realistic and adapt the strategy to the current market conditions.
Precisely. Focus on properties with good cash flow potential that can generate income even if you can't refinance immediately for the full amount.
This has been really helpful in understanding these different approaches to real estate investing. But before we move on, let's take a moment to talk about investor psychology. One source really dives into the emotional side of investing and how our own biases can sometimes lead us to make bad decisions.
Yeah, understanding investor psychology is crucial for anyone in the financial markets. The source points out 3 key biases: loss aversion, recency bias, and confirmation bias.
Loss aversion, I've heard of that. It's the idea that the pain of a loss is greater than the joy of an equivalent gain, right?
Exactly. It means we're often more motivated to avoid losses than to chase gains. This can lead to impulsive decisions driven by fear, like selling investments at a market low just to avoid further potential losses.
Ouch, that's definitely not a winning strategy. What about recency bias?
Recency bias is our tendency to overemphasize recent events when making decisions. For example, if the stock market has been doing well lately, we might get overly optimistic and take on more risk than we should.
So we're letting recent trends cloud our judgment.
Kind of. And then there's confirmation bias, which is our tendency to seek out information that confirms what we already believe. This can lead us to ignore contradictory evidence and miss out on good opportunities.
So how do we fight these biases and make more rational investment decisions?
Well, awareness is the first step. By understanding these biases, we can start to recognize them in our own thinking and take steps to minimize their influence. It also helps to have a well-defined investment strategy. Based on your financial goals and risk tolerance, it can help you stay on track and avoid making those impulsive decisions based on emotions.
It sounds like having a plan and doing your research is key. Speaking of research, one of the sources explores a potential shift in the market that they call the Great Value Renaissance. What is that exactly?
It's the idea that value stocks, those that are considered undervalued by the market, might do better than growth stocks in the current economic climate. With high inflation and interest rates, investors might start looking for companies with solid fundamentals and stable earnings, even if they're not experiencing rapid growth.
The source even mentions Warren Buffett's recent investment in Occidental Petroleum as a possible sign of this trend. But wouldn't just copying what famous investors do be like confirmation bias?
That's a good point. Blindly following anyone, even a legend like Warren Buffett, isn't a foolproof strategy, but analyzing why they make certain moves can be helpful. In this case, understanding why he's betting on Occidental Petroleum could give us insights into his view of the energy sector and the overall economy.
So it's not about mimicking their every move, but understanding their thought process. I see. What would you say is the main takeaway for the average investor like myself?
Diversification, risk management, and really understanding your own investment goals are essential no matter what your investment style is. And as always, do your research and don't be afraid to get advice from a financial advisor if you need it.
Solid advice.
hmm
Now let's dive into a topic that affects everyone, regardless of their investments, Social Security. One source paints a pretty concerning picture of this system, highlighting some potential challenges and an uncertain future.
Yeah, Social Security is definitely in a complex situation. The source starts by explaining the history. How changes in life expectancy and government spending have led to its current financial strain.
It's interesting how it was originally designed when people didn't live as long as they do now. It makes sense that it's facing pressure.
Right, the demographics have changed a lot. The source then goes into the findings from a recent Social Security subcommittee hearing, which revealed billions in improper payments and a surprisingly high number of active Social Security numbers for people over 112 years old.
Wait, over 112?
Oh,
That's
incredible. It is. The Social Security Administration acknowledges that there are some errors, but they say these discrepancies are mainly because of data misinterpretations and old records, not widespread fraud.
So more about administrative issues than intentional wrongdoing.
That's what they're saying. But the source makes it clear that whatever the reason, Social Security is facing some serious financial obstacles. It explores three main options for addressing this: raising payroll taxes, cutting benefits, or increasing the retirement age.
None of those sound very appealing.
You're right. None of them are easy to do or politically popular. Raising taxes is never popular, cutting benefits hurts those who need them, and raising the retirement age can be tough for those who can't work longer.
The source also mentions some alternative solutions, like taxing the wealthy, means testing benefits, or privatization. Are any of those viable options?
Well, each approach has its own pros and cons. Taxing the wealthy could bring in more money, but it might also discourage investment and economic growth. Means testing could target aid to those who need it most, but it might create disincentives for people to save. Privatization could give individuals more control over their retirement funds, but it also introduces market risk and could potentially make wealth inequality worse.
It seems like there's no easy solution and each option comes with trade-offs. What does this mean for someone like me who's planning for retirement? Should I be worried?
Worrying won't help. The key is that Social Security's future is uncertain. It's important to be aware of the challenges and plan accordingly. This could mean saving more aggressively, exploring other retirement savings options, or even advocating for policy changes that you think would make the system stronger.
So knowledge is power, and being proactive about our own financial futures is more important now than ever.
Absolutely. Now let's go back to real estate for a moment. We talked about various investment strategies, but it's also crucial to consider the ethics of this business, especially in a tough market.
That's a good point. It's easy to get caught up in the numbers, but ultimately we're dealing with people's homes and livelihoods.
Right. One of the sources highlights the importance of transparency and fairness in real estate. Are you offering a fair price? Are you being upfront about the seller's options? Are you genuinely trying to help them, or are you mainly focused on your own profit? These are questions worth thinking about.
It's a good reminder that success in real estate shouldn't come at the cost of ethical behavior. Speaking of success, Tim Yu, the investor we talked about earlier, he eventually shifted away from traditional single-family rentals to a more purpose-driven approach. He started focusing on co-living models for assisted living and veteran housing.
His story brings up an interesting question for all investors. What's your why? Is it just about making money, or is there a bigger purpose behind your investment choices?
I think that's something we should all ask ourselves. What kind of legacy do you want to leave behind? How can your investments have a positive impact on your community or the world? It's about aligning your financial goals with your values.
It's about finding that balance between profit and purpose. It's not always easy, but it can be incredibly rewarding. Now let's shift gears and talk about something that's been generating a lot of buzz: the gig economy. One source presents a view that challenges the often praised benefits of this changing work landscape.
Yeah, the gig economy is often portrayed as revolutionary, giving people flexibility and independence. But is it really all it's made out to be?
The source argues that while the gig economy has some advantages, it also presents challenges. Flexibility can come at the cost of job security and benefits. The lack of a traditional employer-employee relationship can make workers more susceptible to wage changes and exploitation.
So it's not all perfect for gig workers.
Not necessarily. The source raises concerns about gig platforms classifying workers as independent contractors instead of employees potentially sidestepping traditional labor protections and placing more responsibility on the individual.
That's definitely something to think about, especially with our earlier conversation about Social Security. If more people are working in the gig economy, it could affect the traditional payroll tax contributions that support the system.
Exactly. The growth of the gig economy could have ripple effects on different parts of our society and economy.
Now, for a topic that's both fascinating and a little unsettling, artificial intelligence. One of the sources dives into the world of large language models and explores whether these systems could become sentient.
It's a question that has intrigued scientists, philosophers, and science fiction writers for ages. Can machines truly think and feel? The source presents two different viewpoints. Some experts say that while these models can generate human-like text, they don't actually understand consciousness or self-awareness. They're basically sophisticated algorithms processing and manipulating information based on their programming.
So they can mimic human communication, but they don't really get the meaning behind it.
That's one view. But the source also points to some emergent behaviors in certain large language models that suggest a basic form of sentience might be possible. It's still a topic that's being debated and researched a lot.
It's amazing to think about what would happen if machines developed real consciousness. Would they be our partners, our successors, or just really sophisticated tools?
Those are questions that will probably be debated for years to come. However, the source emphasizes that even if these models never become truly sentient, their increasing complexity raises concerns about potential misuse.
Especially given how easily humans can be manipulated and misled. Imagine if these powerful tools were used to spread propaganda or create deepfakes that are impossible to distinguish from reality.
That's a valid concern. As AI technology gets better, we need to develop ethical frameworks and safeguards to ensure it's developed and used responsibly.
This has been quite a journey. We've explored everything from real estate and investor psychology to the intricacies of Social Security and the ethical considerations of AI. What stands out to you most from all these sources?
It's striking how interconnected all these seemingly separate topics are. Individual financial choices, the future of work, the advancement of technology, they're all threads in the fabric of our changing world. It's both exciting and a little intimidating to think about the possibilities and challenges that lie ahead.
It's like we're on this incredible roller coaster with no clear destination.
Yeah.
But that's what makes it an adventure, right?
Exactly. And as with any adventure, it's important to be prepared, adaptable, and always keep learning. We need to be critical thinkers, savvy consumers of information, and active in shaping the future we want to see.
That's a great message. Well, before we wrap up this deep dive, there's one more fascinating topic from your sources that we need to explore: the impact of streaming on the music industry.
Yeah, it really makes you think about how much things have changed. It wasn't that long ago we were all buying CDs, and now it's all about streaming.
It's a prime example of how technology can really disrupt an industry, completely change the game. The sources we looked at really trace that evolution, highlighting all the opportunities and challenges that have come along the way. One source actually paints a pretty bleak picture for musicians. They claim that streaming has devalued music and made it nearly impossible for artists to earn a decent living. Is that really true?
It's complicated. There are valid points on both sides. Streaming has definitely made music way more accessible and easier to discover than ever before, but it's also drastically cut the amount of money artists earn per stream. The sources go into the whole system of royalty payments, and it's pretty shocking how big the difference is between what streaming platforms make and what the artists actually receive.
It really is eye-opening to see how little artists get per stream. It makes you appreciate the struggles they're facing in today's music world.
For sure. The sources also look at how streaming has changed, how music is even created. Some argue that it's led to everyone sounding the same, as artists try to cater to those algorithmic playlists and chase viral trends just to get more streams.
So it becomes less about artistic expression and more about gaming the system for streams.
That's one way to look at it. But others argue that streaming has actually been really good for independent artists. It allows them to reach a global audience without needing a record deal. That creates opportunities for artists who might have struggled to get noticed in the old system.
It sounds like they're both pros and cons. More access and opportunity, but potentially at the expense of creativity and fair pay.
That's a pretty good summary. The sources also talk about the rise of short-form video platforms like TikTok and how they're now huge influencers of musical trends. A 15-second clip can blow up and make a song a global hit practically overnight.
It's crazy to think about how these platforms have so much power in the music world now.
It really shows how fast the music industry changes. The sources highlight ongoing discussions about artist compensation, copyright protection, and the role of technology in the future of music. It's a dynamic industry with both challenges and opportunities for everyone involved, both the artists and the fans.
Well, we've definitely covered a lot of ground today, from real estate investing and Social Security to the gig economy and the changing music landscape. It's been quite the deep dive.
And that's the beauty of exploring, right? We've only just scratched the surface of all these topics. It's up to you now to decide where your own journey takes you. What other research are you interested in? What questions do you have? And most importantly, what are you going to do with what you've learned today?
That's a great point. The learning never stops. Keep exploring, keep asking questions, and keep digging deeper. You never know what you might find. Until next time.